Hello and welcome. In today's video, we will be taking a look at my favorite ETF, which is YTSL. YTSL is a covered call ETF managed by Purpose with just one holding, Tesla. Those of you who have seen my previous video where I share my three biggest holdings already know that YTSL is my biggest holding and accounts for almost 30% of my total portfolio. Recently, there was an 83% increase in the monthly income paid out by this ETF. It went from 30 cents per share to 55 cents per share. Hence, I think this is a good time to take a look at its performance in the year 2024. In this video, we will take a look at the total return of YTSL in 2024 and compare it with TSLY, another very popular Tesla-based option income ETF trading on the US stock market. Before we get started, here is a list of things we will go over in this video. First, we will do our usual comparison using the following metrics: capital return, income return, and total return. Capital return will tell us how much each of these ETFs returned purely in terms of capital. Income return will tell us how much yield these ETFs paid out in the year 2024. Lastly, total return will be the combination of both capital and income return. In addition, we will also compare these two ETFs with the Tesla stock itself to see how they performed when compared to their underlying holding. This should give us a general overview of which ETF performed better in 2024, but we won't stop there. Next, we will do an analysis of how the capital returns of each of these two ETFs is impacted based on their respective fund structure. This will help us understand what we can expect from these ETFs moving forward in terms of their capital return. Last but not the least, we will take a look at the trend of the annual yield percentage since inception for both these ETFs. Both YTSL and TSLY started trading back in December 2022, so they have been on the market for a little over 2 years. This means we have enough data to see a trend in the income they have paid out over the past 2 years. What we will mainly figure out in this analysis is whether the income they are paying out is trending up or down when compared to the stock price on the inception date. In other words, if you invested in either of these ETFs on their inception date, has your average income or yield percentage over the years gone up or down? This was something new for me, and the findings were quite surprising too. I have added timestamps in the pinned comment if you want to skip or jump to different parts of the video. With all that highlighted, let's get started. So here we have the comparison of capital gains or loss for these two ETFs in the year 2024. Remember, this only represents the stock price movement for these two ETFs. This calculation was done by subtracting the price at the start of the year in 2024 from the price at the end of the year and expressing it as a percentage of the price at the start of the year, giving us how much each ETF gained or lost purely in terms of capital value. As we can see in this metric, YTSL clearly blows TSLY out of the water. While YTSL returned a 24% gain, TSLY returned almost 35% loss in terms of capital. This should not come as a complete surprise though. It is consistent with the way these two funds are designed. YTSL is designed to capture growth and income, whereas TSLY is only designed to capture maximum income, even if it comes at the cost of capital loss. Nonetheless, it is a massive difference. But does TSLY recover this loss through the income it pays out? Let us check out in the next section. I have now added a second column which shows us the dollar amounts and percentage of income return in 2024. In this metric, the tables have turned. Now it is TSLY whose return is dominant. The percentage that you see in the income return column is calculated by adding all the income that these ETFs paid out throughout the year 2024 and expressing it as a percentage of the price of that ETF at the start of the year 2024. In other words, if you were to make a lump sum investment in either of these ETFs at the start of 2024, then your income yield for that year would be 16% for YTSL and 53% for TSLY. So, TSLY's aggressive approach in options writing does help it provide a higher income, but it also comes at a huge cost in terms of capital value. What this means is that you will need to reinvest some part of that income back into the fund to make sure it does not lose a significant capital value over the long term. YTSL does not suffer from this problem. With YTSL, we can actually take out all the income every month, and still the capital value of the fund will continue to grow, assuming the Tesla stock is also doing well. So, whatever income you receive with YTSL is yours to keep and spend as you see fit. When investing for income, I personally prefer this type of investment. But now let us take a look at the total return of these two ETFs for the year 2024. Last but not the least, we are going to compare the total return of the two ETFs in the year 2024. Here we are just combining the percentage return in terms of capital and income paid out. Overall, YTSL does outperform TSLY and by quite a significant margin as well. In fact, YTSL's total return is more than twice the total return of TSLY for the year 2024. This is an important thing to note because at the end of the day, Tesla is a growth stock, and as such, an ETF designed to capture its capital gains while also providing income will outperform an ETF which is solely focusing on income. In fact, YTS's total return in 2024 also outperforms some of the more popular covered call ETFs such as HYLD and USCL. In defense of these funds, however, I must add that they are broad market ETFs based on the S&P 500 index and have a much lower risk profile compared to YTSL, which only holds one company, Tesla. With that said, what would the table look like if we were to add the Tesla stock itself in the mix to see how the two ETFs performed when compared to Tesla's total return in the year 2024? When we add Tesla's return for the year 2024 on the table, it definitely overshadows the returns of both YTSL and TSLY. This again should not come as a complete surprise because any ETF designed to capture options income is only able to do so by giving up some amount of the capital upside. Hence, both YTSL and TSLY are bound to lose some portion of the capital upside during bullish periods. But during bearish periods, these ETFs will also outperform Tesla because the capital loss will be offset by the options income. Nonetheless, Tesla's total return does stand out by a significant margin. It is almost four times the total return of Tesla and almost two times the total return of YTSL. This begs the question, why is the difference so significant even with YTSL, which is in fact designed to capture capital upside? We will answer this question in the next part, where we take a look at how the fund structure impacts capital return. The capital return of a fund is heavily dependent on how the ETF is structured. The table you see on the screen highlights how the capital appreciation or depreciation happens in these two ETFs based on bearish or bullish trends in the Tesla stock. Let us take a look at YTSL first. It uses a 25% leverage, and this means that whenever Tesla stock is bearish, it captures all of the downside plus the 25% leverage. So if Tesla stock went down 100%, this ETF in theory would lose 125% due to the added leverage. It is important to note that this added 25% loss in terms of capital value is offset by the income received from the options sold, and some of that income could in fact be reinvested in the fund after the monthly targeted income is paid out to investors. So it is possible that during a prolonged bearish market, this ETF could actually outperform Tesla as it is receiving the options income and also able to buy additional shares of Tesla at a cheap price. At the same time, during a bullish trend, it only captures anywhere between 60 to 100% of the capital upside. This is again because of the covered call writing being done on up to 50% of the total holdings of the YTSL ETF. This explains its underperformance in terms of capital return when compared to Tesla stock. But it still manages to capture a significant chunk of capital gains, enough to ensure that its overall capital value will continue to trend upward as long as Tesla itself is bullish in the long run. But the same cannot be said about TSLY ETF. If we look at how the TSLY ETF is structured, it gets even worse. It only captures up to 15% of the capital upside during a bullish trend because of the aggressive nature of options writing. At the same time, it will capture 100% of the downside during a bearish trend. Based on this structure, this ETF is guaranteed to lose its capital value in the long term. When you are only capturing up to 15% of the upside but 100% of the downside, it is highly unlikely that the ETF could have a positive return in the long term. This is evident from the decline in its price from the time of its inception. Even though TSLY is generating a higher yield, it is giving up too much of the capital upside and ends up heavily underperforming in terms of total return, as we saw earlier. So, the way these funds are structured plays a key role in their underperformance when compared to Tesla stock, at least as far as the capital return is concerned. But we must not forget that these ETFs are designed to generate income, and as long as they are able to generate progressively higher income, then they might still end up being a good investment for someone who is primarily focused on income. So, in the next part, we will see which of these two ETFs is actually able to ensure that it is not just generating income, but also over time is able to increase the income it pays out when compared to the fund's value on its inception date. This first chart shows us the dollar amount paid by TSLY every month from its inception date up to February 2025. These amounts are adjusted for the reverse stock split that happened in February 2024. I have also rounded off the amounts up to two decimal places for ease of presentation. One thing to notice about this chart is that the overall trend of payouts is moving downward. It may not be completely apparent at first glance because there are a few spikes in between, such as the $2.13 payout in January 2023 and the $2.50 payout in December 2024. But apart from these two spikes, you will notice that the trend is in fact moving downwards. Some people in such cases tend to assume that if we take the average of all the payouts, then the overall average yield of this ETF will actually turn out to be great. And I did exactly that to see if this assumption is correct. In fact, I went one step further and calculated the average yield of this ETF after every payout they made since inception and plotted it as a chart, which you can see on the screen right now. The numbers you see on this chart represent the percentage change in the annual yield after every payout. Thus, after the first month's payout, this ETF's annual yield was 58%. After the second month's payout, the average annual yield dropped to 55%. After 3 months, it was down to 54%. And after 6 months, it was down to 47%, and so on. I have used the fund's value on its inception date as the basis for calculating these percentages. In other words, if you had invested in this fund as soon as it started trading on the market, as of today, you would have received an annual average yield of 33.61%. Unlike the previous chart where we see only the dollar amount of the payouts on a month to month basis, in this chart we get to visualize the average of those dollar amounts expressed as a percentage when compared to the fund's value on its inception date. Thus, we are able to get a more clear picture on the actual trend of the payouts. If you go to Tesla's website now and check the income yield, it will show you somewhere around 80%. But remember, that yield is based on its current stock price and its most recent payout. The yield percentage displayed on the website does not actually tell you whether the fund is progressively paying out a higher or lower yield. So, if you were to purchase Tesla today based on its current stock price and current payout levels, you might receive an 80% yield for the first few months, but over the long term, that is, over the next 2 to 5 years, what you will notice is that your yield is consistently declining based on the cost price at which you purchased it today. At least that is what this trend predicts. So, unless YieldMax makes any major changes to the strategy, this is how it has worked so far and it will continue to work in the future. But what about YTSL? What results do we get when we perform a similar analysis on its payouts? First, let us take a look at the dollar amounts it has paid out since inception and if we can notice any trend over there. The chart you're seeing on the screen shows the dollar amounts it has paid out since inception. Once again, I have rounded up the numbers up to two decimal places for ease of presentation, and this time the amounts are in Canadian dollars since this ETF trades on the Canadian stock market. What you will notice is that for the most part, the ETF pays out a consistent amount, such as for the first 6 months, it paid out approximately 31 cents. Then there was a spike in between for a few months when Tesla stock was actually quite bullish. But later on, when the stock became bearish again, the payout amounts dropped down to 30 cents per share, which was slightly lower than the amounts they were paying out originally. However, in the month of February 2025, we have another spike because recently Tesla stock did go up by quite a significant margin. At the same time, since then it has been in a bearish territory, and we might expect the payouts to go down again in the near future. So, overall, this ETF has managed to maintain a stable level of payouts just based on the dollar amounts. But what trend would we see when we take the average of every month's payout and express it as a percentage of the fund's value on its inception date? This next chart shows us that trend. Once again, every number on this chart shows the month to month change in the average yield percentage of this ETF since inception. In other words, if you had purchased this ETF as soon as it started trading on the market, after the first month's payout, your average annual yield would have been 23.53%, and it would have remained that way for about 6 months, after which it would have grown up to 25.78% around February of 2024, when there was an increase in the payout amounts. Again, it would have remained in the 25% range right up until December 2024, where it dropped slightly below 25 at 24.93%. But again, in February 2025, we jumped back up to 25.7% with another increase in payouts. So, in absolute terms, the difference is not much. The annual yield percentage has jumped from 23% at the inception of the ETF to 25% as of now. Nonetheless, it is a change in the right direction. What this tells us is that someone who decided to buy this ETF back in December 2022, when it started trading on the market, would have bought it with the promise that the ETF would generate around 23% annual yield. But as of February 2025, the ETF has generated on average 25.7% annual yield. This is the exact opposite of what has happened with TSLY. A person buying TSLY ETF back in December 2022 would have bought it under the impression that it would pay out approximately 60% annual yield, but as of February 2025, it has paid out on average 33.6% annual yield. So with YTSL, I expect this upward trend of income yield to continue. Of course, a big caveat with this expectation is the fact that Tesla stock should continue to perform well in the coming years. But based on what we have learned so far, as long as Tesla does perform well, YTSL should grow both in terms of capital and income payout. Tesla, on the other hand, will require some drastic changes to improve its long term performance. 2024 was a bullish year for Tesla, yet Tesla returned a negative 34% in terms of capital return, and even in terms of income return, their payouts trended downward throughout the year. So, unless YieldMax makes some major changes to how the ETF is structured and how they generate the income, I do not see any major positives for this ETF moving forward, even if Tesla performs well in the future. With that, we come to the end of this video. In conclusion, I would like to reiterate that at the end of the day, the Tesla stock outperformed both Tesla and YTSL ETFs. So, if you are looking for the best possible return, then just holding the Tesla stock is the best option. However, in my case, YTSL meets the requirements of what I'm looking for in an investment, which is an ETF that captures enough capital gains to outperform the inflation. And on top of that, it is paying out an average of 10 to 12% annual income yield. And this yield should, over time, trend upward. YTSL not only meets these requirements, but so far it has performed well beyond my expectations. Hence, I will continue to hold this ETF and keep it as my biggest holding at around the 30% weightage of my total portfolio. The only time I would sell this ETF is if there is any major change in the fundamentals of the Tesla stock itself, which at the moment does not seem to be the case as Tesla continues to further innovate with its humanoid robots, robotaxis, and the Grok AI. I think the stock is quite likely to grow in the future, which means further growth for YTSL both in terms of capital and income. Let me know in the comments if you hold either YTSL or the Tesla ETF and if you're planning to hold or switch to some other ETFs or just go ahead and buy the Tesla stock for the best total return. As always, the information provided in this video is based on my own research and includes my opinions. Make sure you do your own research before making any investment decisions. Thanks for watching. I will see you guys in the next one.